Hi, welcome back to the Nest Trades YouTube channel. If you guys are new here, make sure to check out all of the content as well. We have tons of free content for you guys. We have videos that cover risk management, how to pick winning stocks, setups that I personally like to trade, and many other videos as well. So make sure to check them out. And if you guys find this video helpful in any way, we would really appreciate you guys dropping a like. And also feel free to check us out on all our other platforms. You can also find us on Instagram, Twitter, and TikTok. So make sure to check that out as well. Anyways, in today's video, we're going to be talking about knowing when to exit a trade. And this was actually a question asked by one of our Discord members, so shout out to that person. And if you guys have any other topics you guys want us to cover, just drop it down in the comments below and I'll make sure to cover that in a future video for you guys. And the first point I want to make is that no trader is perfect, but we don't necessarily have to be perfect. And the reason this is important to this topic is because some traders, they expect to be able to hit the exact bottom and get out at the exact top. But that's not really a realistic expectation to have, nor is it necessarily what we need in order to make money, right? At the end of the day, our goal as traders is to make money. And to make money, we don't have to capture the whole entire move. We just have to find opportunities, and we just have to be good at gauging how big that opportunity potentially is. And so based on that, we set a defined risk amount. Once we make enough to justify the risk we took on, then at that point, if we get out and the trade ends up going without us even more, that's okay, right? Because we ended up making enough to justify the risk, which means that in the long run, if we take that trade 100 times and we always prioritize our risk reward, then it won't matter if sometimes we miss a little bit extra, right? Because we know that statistically we're going to be in a position to make money because of how we've positioned ourselves based on the risk reward, right? And so I like to use this analogy of people surfing, right? Think of each trade opportunity as a wave, right? And the bigger the wave, the bigger opportunity you have to surf it, right? But the bigger the wave, the harder it might crash on you. So taking that into terms of trades, right? The bigger the opportunity, the more risk you're going to have to set aside in order to be able to capture more of that move. But if there's smaller waves, right, there's going to be less risk involved. And so you're going to be more able to catch those moves. And they're going to be a lot more frequent. And again, they're going to be a lot safer. And what this all comes down to is risk reward, right? So whenever you enter a trade, the risk reward has to make sense. So when it comes time to exit a trade, what really matters is, did you capture enough in order for the risk to have made sense? So if we look at this example here, we're looking at 1 minute candles on the QQQ. And let's say our entry signal was once we broke the low of this candle, this green candle right here, with this red candle, that would be our entry point right there. And our potential target would be making a new low of day, right? Because our trade idea is that, we made an upwards move, but now we're starting to shift momentum and we're going to be headed to the downside direction. Right? That's a pretty reasonable expectation to have. And so you might place your stop at the high of this candle. So if we end up making a new high of day, that would be telling you, right, we're not really changing momentum. We're still trending up. And so you would get out and take a small loss. But it makes sense to enter this trade because, right, what you're risking is, all right, in this case, probably like 30, 40 cents. But you have the potential to make 80 cents to maybe $1. So it makes sense to take this trade, right? And the question from the person was, how do you know when a stock is done, right? How do you know when it's done making its move? Well, that's going to vary depending on, right, how big you think the wave can potentially be. That's going to vary, right, depending on the type of trade you're taking, the reason you entered, the setup that you looked for in that trade. And in this case, it was a 1 minute setup, right? So we're looking at 1 minute candles. And so your target can't really be that high, because if you set a really high target, then this risk is not really going to make sense, because although in this case it might have worked out, like if we look at QQQ, this is where we took the screenshot, right? The trade ended up going a lot further down, but you couldn't really have expected to capture all this while only risking this much, right? Because although in this case it did end up working like that, You can't think of it in terms of one trade. You always have to be thinking in terms of 100 trades, right? And in the long run, if you're only risking this much, your win rate is going to be super low if you're going to be trying to hold for this entire move, right? Because more times than not, you're going to end up entering here, expecting a move here. And if your risk is up here, well, if it comes down here, you're not going to be able to take profits because your target is all the way down here, right? And then what ended up happening? We ended up coming back down, and then we ended up making a new high. So you most likely would have got stopped out here, and then it would have ended up going in your direction, and you probably would have been frustrated, right? But why did this happen? Well, because your target was really big for the amount of risk you were taking on. If you were only risking 30 cents and hoping to make $3, that's not really, or this was actually way more than $3, but you see how that doesn't really make sense, and you can't expect to make this much if you're only risking this much, right? And as we can see in this case, it wouldn't have worked out because although yes, if you would have bought here and then just closed your eyes and taken a nap and woken back up, you would have been up. But if you had your risk set here and your target set here, you would have got stopped out because in this case it ended up breaking that and you would have had to stop out. Only then to see it go and hit your target, right? But yeah, hopefully that makes sense. But what I'm trying to say is that when you're looking to exit a trade, it's all based on your risk that you're taking on. If you're risking 30 cents, well then it makes sense to try to go for 60 cents in your favor, right? But if you're risking 30 cents, then it doesn't make sense to try to make $3 on that because you're gonna have a really low win rate. And unless you're okay with that, then I guess you can potentially try that out. But more times than not, it's not gonna really work out. But what you can do is if you're hoping to get this big of a move, well, what you can do is you can adjust your risk. So, and also change your time frame. So in this case, we're looking at daily candles, right? So instead of 1 minute candles like here, we're looking at daily candles. And now you can actually expect to get a lot more of the move because now your risk is set at a higher point. You're risking $3 here, and now you can expect to make $6, $7, $8 in your favor. But at the end of the day, how much you're gonna be able to capture the move is based on what you're risking as well, right? The higher the risk, the more potential reward. And obviously, one way to determine how much you can expect from a move is by what time frame you're looking at. If you're looking at a daily time frame, then obviously you're going to be looking for a bigger move. But if you're judging your trades and your entries based off the 1 minute, then you have to lower your expectations and look for those smaller moves. Now, the person that asked this question was also asking like, okay, well, how do you know when to sell? Well, I just try to explain it using the risk reward, but I'm guessing he also wanted to know like signs on the chart that tell you when to exit. So let's go back to this example here and talk about what clues from the chart we got to exit out of this position. So here we have our trade plan, right? Enter here, exit here, take profits here, and stop loss here. Well, the stock ended up hitting our take profit and we ended up taking profits here. No matter what ends up happening, we're okay with that and we take our profits there. But when you hit your take profit, doesn't mean you have to sell 100% of your position, right? You could have maybe chosen to sell 50% or 75% just to make sure you lock in those profits and minimize your risk on the rest of the trade. But just because the trade has worked out doesn't mean you have to exit all of your position. So let's say you exit a portion here and then you leave runners, right? Or the remaining of your position to see if you can capture a bigger move. Well, this candle ends up going lower, so you wouldn't have sold the rest here yet. And then we end up pushing a little bit higher and it reaches this point where it's the EMA. But here, it still wouldn't have been an indication to sell because at this point, on the remaining of your shares or your option contracts, you're still in the money, right? Because it's much lower than your entry point. So here you would still be holding, and then you would be hoping that it rejects on the EMA, which it does end up doing, and then it comes down and makes a lower low. So at this point, you can take more profits, or you can still decide to hold if you're looking for even more on the remaining of your position. So then we started consolidating, and this could potentially be like a bear flag here. But then we see this candle here, and this would be your signal to get out. So the person that was asking the question, how do you know when a trade is done? Well, this right here would have been your exit signal on the remaining of your position, right? Because first of all, we see increasing volume, so that's one sign there. And look at the size of this candle, right? It's taking out 1, 2, 3, 4 previous red candles in just one go. So at this point, you would obviously want to step out because that's a clear shift in the momentum. Even though we know that in hindsight, right, that ended up giving back this move, and if you would have held through all that, you would have ended up being okay. But we can't think like that, right? Like when you were in the trade, you wouldn't have been able to see all this. So the only information you had was this. Well, you had to exit the trade no matter what, because again, based on your risk, you have to just exit. And then once we see this, well, then you can decide to re-enter the trade, but now that's a completely different separate trade. But for this trade, this candle would have been a clear indication to get out. Right, now let's look at another example. Let's say you're looking at the 5-minute candles, right? So let's go back to this area here. So let's say you end up entering here. This candle ends up breaking the low of here. So let's say you end up entering here, right? When this candle breaks, when this red candle breaks the low of this red candle. So let's say you end up entering there. Well, one thing you can do as well to see whether or not it's the right idea to exit a trade is look at the overall trend, right? So here we're taking a trade based on the 5 minutes. So we might set our risk on the high of this candle, right? So that's our stop loss, and a potential profit would be breaking pre-market low. All right, so that's our trade idea right there. That's our take profit. This is our stop loss, and this is our entry. So let's make this white. Boom. So that's our trade idea, right? And when we enter, we only have this as information. So we enter here, we get a move in our direction, and then we start popping up, but you don't exit the trade because, you know, your stop loss is up here. And at this point, this candle is making a lower high. So you see how this is a relative high here on the chart. This is another relative high, but it's lower than this high, which is a good indication. So that would actually be a good sign for you, and you could potentially add more to your position here on this candle once it breaks the low of this candle, potentially, right? And then we end up coming down here and we hit our target. So here we could have, you know, taken profits, taken half off, or, you know, whatever you wanted to do, but it would be smart to take profits here. And then we ended up coming back up, but look at this. Do you see how this is lower than this point? So this is another lower high. So that would be another good sign for your trade and a potential spot to add once this candle breaks the low of this candle. So then you keep holding, right? We end up coming down here and then we bounce. So this would be a little bit concerning because in this case, we made a higher low. So we ended up not breaking this low, which is a little bit of a bad sign, but you would still be in because you've already taken profits, and we're still overall down, right? Because we're making lower highs. So then the thing you would be really focusing on is seeing if we would end up breaking this. If we end up coming back up and breaking this, then I would potentially think of getting out of the trade. But we don't. We end up coming here and look what happens. We end up making another lower high. So that would be a good sign. And then we see this candle right here. This candle is really telling because of the size of it. And look how it ends up giving back all this plus some, right? So it takes out this whole green candle here. That would be a really good sign. And you could potentially decide to add on this candle. And then we keep going. We come back, we make a new low, another good sign to keep staying in the trade. So in this case, we make a lower low. So this was our most recent low, then we make a new low, a good sign to stay in the trade. Then we come back up, but we don't break above this, which was previous support. You see how it was struggling to break below this level, but now that it's below it, it's struggling to break back above it. So that would be another good sign to stay in the trade. So then we stay in, we make a new low, another good sign. And then we come up and once again, it's acting as resistance. So that would be a good sign. We come down This would be a little bit like, oh, okay, what's going on? We're not making a new low. Maybe it's time to take profits, but let's wait and see if we end up making a higher low. We come back up and we don't break this high right here. So lower high, lower high. So at this point, we're still in the trade. Then we come down and then we end up making a new low. Again, good sign, reassurance that we're in the right trade, right? We're still with the trend. We end up coming up, and again, we establish a lower high. So at this point, you're still in the trade on your remaining shares or contracts. Then we come down and then we break this low, and then we get a really big flush. So at this point, you're really in the money at this point. So at this point, it'd probably be smart to take some profits here and then leave your remaining shares. But also because we get this big move, we don't necessarily want to be looking at this relative high anymore. Now we maybe want to move it to our stop to this candle because it's just too big of a gap, right? Like, why would you get this move in your favor and then just let it come all the way back up and give all that up, right? Once you get a big move like this in your favor, you want to make your stop tighter because this is giving signs that, all right, now the move is getting pretty extended. We can probably expect some consolidation or a pop back up because we've just oversold too much. So that would be a smart thing to do. Move your low here. All right, and then we keep going down, make a new low, good sign. Then this is our first like green candle, but it's pretty weak. And then look what happens next. We take it out. So this would tell you to stay in the trade. Then we make a new low, good sign. Then we come back up and we start trying to like get above this green candle here, but it's not significant enough, right? Like this is our overall stop loss. So at this point, we're still in the trade. And if we think of it in terms of here, we made a lower high. So that's a good sign. Then we come here, make a new low. We don't get too much continuation on that. So that's a little bit red sign. And this candle also takes out most of this red candle. So here it'd be a little bit iffy. But ultimately, I would be looking at this. If it starts coming up here and making a higher high from here, then I would probably think of getting out because then it looks like, all right, the trend, this big move down is most likely over, at least for the day. But it doesn't end up happening, right? We never end up coming back above this level. So at this point, this is now your lower high. We come back down, we make a new low, another good sign. Then we come back up. Again, this candle is a little bit worrisome, but ultimately you're looking to see if it ends up coming back up here, which it doesn't. It makes this wick, another good sign. So this is now your lower high. And then we come down and then the day pretty much ends. So that's one thing you could do. Just look at lower highs, lower lows, or higher highs, higher lows. Just look at the overall trend, and that's how you know whether to stay in a trade or not. And if you go back to one of my videos, I think it was on Lucid, I go over this exact same thing. And that's how you know whether or not to get out of a trade. Is just look at the price action. If it's making lower lows and lower highs, that's a sign to stay in if you're in puts, right? If you're playing to the downside. If you're playing to the upside and you're looking for an uptrend, look for higher highs and higher lows. Which if you go to that Lucid example, that's exactly what we saw there. And so that would be a good example of how to stay in a trade that's a bullish trade. And then this is example of a bearish trade. And this, again, you would want to do it with runners. Like you would take profits here like that. Like it would still be a good idea to take profits here. And then on the remaining shares, right, because you're more comfortable with that, you can try to play it all the way back down to the downside. But it's really important that you take profits at this point, because once you get a move in your favor, it's good to take off that risk and make you more comfortable. So let me paint a scenario here to explain this. So let's say there was a plank, right, that you had to walk across, and it was placed 5 feet above the ground. You probably wouldn't have too much trouble crossing it because there's not that much risk involved. But let's say you placed that exact same plank, but now it was 100 feet above the ground. Now you would probably find it troublesome, or it would be a lot harder to do that, even though it's the exact same task as the exact same plank. But now there's a lot more risk involved, right? So you're probably going to approach it a lot more cautious, a lot differently, and you can relate that to trading and think of the position above the ground as your position sizing, right? So if you enter a trade here, right? With this being your risk, and then you get a move in your favor. It's smart to take off risk because now it's like you're moving the plank down, right? Instead of the plank being 100 feet off the ground, which is how you might have felt when you were full size here. Well, once you take off half your position, right, you're going to be much more comfortable being able to hold it for the rest of this move because now there's less risk involved, right? You already know that there's profits realized. You already have that in your pocket. So it's going to be that much easier to be able to hold through all this because in this little bounce here, if you didn't take any profits, you'd probably start getting nervous and you'd probably be like, maybe I should cut it here. And in hindsight, you're like, well, no, I would have held it. But you don't know that, right? If you're seeing this candle right here, that's getting a little bit iffy. And if you didn't take any profits here, it's going to be hard to hold that position, seeing this go against you. And when you're actually in the live action and you're seeing your profits just evaporate, right, it's going to be really hard to hold this position. But if you take profits here, then it's going to be that much easier to look at this objectively, look at it and be like, okay, well, this is still a lower high from here, and so you end up holding, and then you're able to catch much more of the move on your remaining position. Plus, not all the trades are going to end up working this beautifully, right? There's going to be many times where it's going to come down here and then it's going to end up coming all the way back up. So it's always smart to take profits when a trade goes in your favor right away, and you already made more than what you were risking. So it's smart to take profits and then let the rest ride, right? So just something I wanted to elaborate on and make very clear that that's how you should be managing your positions. But anyways, I know this was a little bit of a longer video, but I hope that explained your question and you have a better understanding now of knowing when is the right time to exit out of a trade and not cut it too early. Other than that though, thank you so much for watching the video. If you guys did enjoy, leave a like. And other than that, I'll catch you guys in a future video. It's been me, Zero.